Hello, everybody. Thanks for joining me today here at TSLA. My name is Mark, and I'm here to report that once again, Tesla closed in the red. I say the same words basically every day, hoping to change them, but it is not too surprising if you are a regular viewer of the channel that Tesla sold off pretty considerably. Once again, underperforming the market, even just based off its beta. It's 3.16% down, whereas the NASDAQ is down just a little over 1%. That was a drop of $7.36 from yesterday's closing price, and today's closing price was $225.60, and that's on August 16th, 2023. You can also see in our little blue line that the after-hours trading has sent the stocks down another $1.70 or something like that. So if this holds, don't be surprised tomorrow that there will be another gap down like there was today, and that any rally is quickly sold. So it's one of those sell the rips, and you'll see based off this chart in this kind of wedge pattern that we were looking at before, that it was always lower highs, it's always lower lows. No high is ever being taken out on this time frame. I mean, other than a couple second time frame or couple minute time frame, no highs are ever being taken out. Even if you were to close the gap like we did today, it sold off very fast and closed lower than the opening gap down was. Unfortunate. Now, I know we drew this kind of squiggly line going up. I don't think we need that squiggly line going up anymore. If you haven't watched my previous videos, that line was saying if there was a bullish breakout of the wedge or this falling triangle-ish pattern, if there was a bullish breakout, it would have been a break above, a close at the trend line again, and then kind of ripping up. Unfortunately, we still have the green line, which is basically following what we thought would happen. It would be, we would dip into the gap. We would sell off pretty sharply past the gap. We got bought back into that wedge, and we fell out very briskly. Today, it gapped down like we mentioned earlier. It did get bought up. We thought it would kind of try to test this trend line again. And as that happened, it sold off completely and close well below the low of the morning. And I think we kind of know why, but we're going to explain further about the potential possibility of can this go down even more, why exactly can't the market sustain itself, and we'll do that by, well, firstly, there is no real Tesla news. There is, of course, always Tesla news, but none of that news is, despite what bulls say, is going to be relevant to the stock's price action. Introducing new models, selling new gear as far as, towels and what have you. None of that's going to affect the stock. What we need is basically proof that margins have bottomed. We need proof that FSD is on the way, and we need proof that the new models that are to be released will be released this quarter. I think those are the really important bits of information. Unfortunately, we have no clarity from Elon or from the Tesla team about when the Model 3 Highland's coming out, or if it even truly exists, quote unquote, in the way we consider it to be one that might have manufacturing efficiencies built in through the use of gigacastings. When is the Cybertruck going to be released? Will that handover event be this month, next month, by the end of the quarter? No real information has been confirmed, though we, of course, have heard before that the handover would be sometime in Q3, which is this quarter. So let's go ahead and just take a look at some tweets from the ever so controversial Zero Hedge. But the reason I want to bring this up, because I think they're actually relevant to the price action for the market, and especially for Tesla, due to these very rate sensitive stocks that are auto manufacturers and what have you. Also, the meme-like stonk type of stocks, they've been selling off very, very quickly. And that's all because of those type of stocks would never survive in a higher for longer rate environment, in which is we are currently in. So FOMC minutes came out at 2 p.m. Eastern today. Here's a brief synopsis. Zero Hedge says 2 Fed officials favored holding rates steady in July. Out of all of them, most of the Fed officials saw significant upside risk to inflation. Fed minutes, inflation risk could require further tightening. They're very worried that that if they were to stop raising rates, if they were to start cutting rates anytime soon, what basically would happen, it would be like a redo of the 1970s where they stopped too soon and inflation took hold once again and it went insane. So, there is some truth to that. Zero Hedge goes on to say, and we'll read a couple of these tweets, a couple of participants indicated that they favored leaving the target rate range for the federal funds rate unchanged, or that they could have supported such a proposal. So basically, it wasn't a large majority of people wanting to actually pause, but there was some people that are wanting to pause. So these type of minutes, it takes a while for the market to digest and understand what kind of the gist of that meeting really was. And you can see that through the price action of stocks when it was getting bought up into the minutes being released. It kind of held its own. It kind of had some pumps for certain tickers during the digestion of the minutes, but eventually it sold off and yields increased. Zero Hedge goes on to say, from some quotes from the meeting minutes, participants noted that a gradual slowdown in economic activity nevertheless appeared to be in progress, consistent with the restrained place on demand by the cumulative tightening of monetary policy. He goes on kind of snarky reply to that with a 5.8% GDP, which is currently the yearly GDP that's being forecasted by the Atlanta Fed. FOMC minutes goes on to say, participants continue to view a period of below-trend growth in real GDP and some softening in labor market conditions as needed to bring aggregate supply and aggregate demand into better balance and reduce inflation pressures. He goes on to say, once again, 5.8% GDP. This is, these GDP readings are from the Fed, from the Atlanta Fed. So it's kind of like, who is this meeting minutes really talking for, or what data are they seeing? Now, don't get me wrong. It's not like I want them to keep raising rates to restrain GDP and to restrain growth. It's just that it always seems like the FOMC participants, the governors of the different areas of the Fed, I'm not sure if they have a really good up-to-date understanding of how the market is actually functioning. Participants commented that monetary policy tightening appeared to be working broadly as intended. While the overall banking system retained ample loss-bearing capacity, some banks experienced sizable declines in their fair value of their assets as a consequence of rising rates. Now, these two comments could be construed as a little bit of a possibility, that rate pauses could continue. And the reason for that is because they are further addressing, and this is something they've actually addressed since last year, that these losses on these banks' bond portfolios are very, very, very large. The value, of course, these are not realized losses. These are losses that if they were to need the liquidity and were to sell these bonds, they would sell at extreme losses. And that's why the Federal Reserve created the programs to actually sell back bonds at the value that they paid for them. In case a bank was needing liquidity. And we know that those programs, the various programs, it's like BTFP and what have you, these Federal Reserve programs are being used still. And some of these loan balances are increasing on a weekly basis. So we know that there's some stress in these smaller banks out in the regional banking sector of America. Since the emergence of stress in the banking sector in mid-March, indicators of spending and real activity have come in stronger than anticipated. As a result, the staff no longer judged the economy would enter a mild recession toward the end of the year. Now, this is something that they kind of changed their tune on earlier in the year, where they started, it's possible that we can slip into a recession just because inflation was so sticky, and then market conditions over the course of the late spring into early summer kind of showed that the stocks are getting bought up because we're not actually having any realization of a slowdown in the average consumer spending habits. And even though rates are really high, we get that homes aren't going to be really purchased and cars might not be really purchased, but companies are not going bankrupt as what we thought they would be. If you look at retail earnings for this week, you would figure that retail would be hard pressed to meet the expectations that the street is setting for them. If there's any sector, it would be them. But you have your TJ Maxx's, you have your Targets actually doing surprisingly okay. In another tweet, this would be another situation that we need to really watch, is the yen. So the Japanese yen down 8 days in a row, the longest stretch since October 2022 when it ended with BOJ, Bank of Japan intervention. Now you probably remember this happening shortly after the Jackson Hole era. This was probably in September, October, November of last year, where we saw a lot of turbulence in the markets due to how yields were being kind of manipulated by the Japanese yen's basically they're trying to get the yen back under control. The Bank of Japan would sell American bonds. They would use those proceeds to then purchase their own Japanese bonds, hoping to control that very weak yen. But we're getting to the point where the yen is getting very weak. So I wanted to show you these tweets because these are the real relevant tweets. This is the Cybertruck release or whatever. That's not going to affect the value of your Tesla shares. What's going to affect your value of the Tesla shares is the overwhelming gain in yields. That's the real issue at hand. So that's something that we really need to take a look at when we start charting, and we're going to move over to the charts right now. So we're back at Tesla, and I guess it's not finding any support in the after hours. Let's look at the minute and let's go small time frame first. So you can see how we try to get back. So it was a gap down in the morning. It was a pretty sizable gap down. You were probably there. And it was 2.4%. And we actually saw around $227.40 in the morning. And that was quickly bought up. And that recovery was at kind of a double top. This is almost like a perfect double top. It was a 2.86% gain in the morning, which would have been a fantastic move if you were kind of getting a perfect entry here. I think that'd be actually very difficult based off this candle. I don't think anyone had a great no one had really good entry because this is a 1 minute candle, and that 1 minute candle was about a $2 difference in share price. So some people got some really good entries, but the better entry was actually shorting the top. Shorting on the double top would have been the better entry. And this is what we can kind of consider. We would gap down, okay, and we would try to reclaim the bottom diagonal, this diagonal trend line, which formed the bottom of the wedge. We would kind of need to reclaim that somehow, kind of like what semiconductors did earlier this week. Reclaim that and close within this area somehow, some way, or even above on a very bullish day. But instead, we actually sold off very hard. I mean, on the first drop, that was a 3%. Move down, which would actually beat the low of the morning. But then by the end of the day, that was 3.6% down, and we're still selling off in the after hours. So if you want to include the after hours from the intraday high to the current after hours pricing, it's 4.36% down. Not the greatest of looks. We kind of anticipated this, that if this was the type of sell, it would look like this. I haven't touched this green line since we've drawn it, and it is basically doing what we thought it would. And what are we looking at for a bottom side target if there was to be more selling? Well, hopefully there isn't more selling, but I mean, what? I mean, there's got to be some crazy news to come out of Asia, and that's something for you guys to watch. This video might come, you might watch this video before the Asian futures open or the Asian markets open, be it the Nikkei or the Chinese mainland market or the Hong Kong market. Something to really kind of consider is watching those to have a better idea of how do you want to trade tomorrow. Do you need to close out any shorts, or do you need to close out any hedges, what have you. But something to watch is the performance of the Nikkei, watching the value of the yen. We'll take a look at the yen and yields on US treasuries as well. So we've always been looking at this gap, which is going to be if you would close it somewhere in that 222 area. But what would probably happen is we're getting so close to the gap now. If this was to open below the gap, you can find some interest right here at 219, I believe, is where, and we can take a look at the moving averages to kind of get a good idea. But I believe, if I remember correctly, and let's try to find a example of an EMA. Any good EMA indicators here? And let's switch to the daily time frame, and we'll kind of look to see. I believe there's going to be a kind of some commonality with this with the 200 day into the gap. So that's their hope and prayer, is that we won't fall below all the moving averages, but we fall in through most of them. And so our last bastion of hope is going to be around the 219 to 222 area right here. upside, I mean, who cares? Like if it goes up, perfect. If it doesn't go up, these candles are disgusting. These are horrible looking. This is horrible looking trading. I mean, I can't even explain it. Is there another good example where we go down for like 40 days in a row? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. So around 15 red days since the earnings. 1, 2, 3, 4, 5. And 5 green days. So out of the last 20 trading days, we've gone up 3 times, and you can kind of see how when we start getting below trend lines, moving averages, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. I mean, even this drop after the spring consolidation, that wasn't even how brutal. Like to understand how brutal it is, maybe we should go look at when we fell from the purchase of Twitter. So that's 1, 2, 3, 4, 5, 6, 7. We'll just do, I mean, we can just measure this, right? So we don't have to count. And we can we go this way first. So it's 15 bars and 2 are green. And this is 20 bars, 19 bars, and there is 5 green. So yeah, so this is kind of comparable to the drop from when Elon was selling shares for Twitter. I mean, the drop isn't as drastic. What is the drop so far from earnings? If you go from the low from the day before earnings, about 22.5%. If you want to go from the recent high, we are 24.6% down. So it's still a pretty considerable move. That is $73.52 a share from that high before the day of the earnings report. So that's a considerable amount. That's 1/4 of the value of Tesla shares being lost. And ironically, it is very possible that we can continue to sell just based off typical price action. Retracements of moves up can be very, very severe. Retracements back down, that is. So yeah, that's Tesla so far. I mean, there's really nothing to note. Below most moving averages, intercepting a new gap to be filled probably within the next 1 to 2 days, depending on how the Asian markets open. There's really not good enough economic information that will drop tomorrow, I don't think, other than jobless claims that can really get Tesla moving. But jobless claims wouldn't be really the greatest bit of information to pin your hopes on that Tesla would actually go up tomorrow. It needs to be something fundamentally sound of the company being revealed, like costs and details about Cybertruck's release. Kind of trying to explain to the market why maybe production volumes are down due to the fact they're retooling for the Model 3 Highland. That's a good possibility. Or some type of idea of when full version of FSD will be released, or having FSD available in its entirety to more countries. That would be another little bit of information. And lastly, the revealing of an OEM manufacturer interested in licensing FSD software and hardware for their own EV cars. So we talked about the yields, and yields are really what's putting pressure on stocks, especially stocks like Tesla, like the really high beta meme-like stocks, small caps who aren't really cash heavy. Companies basically relying on financing to stay in operation. Unfortunately, higher yields are not going to help their case, and you can see it here. I kind of had a comparison of the Nasdaq over the U.S. 10-year yields, and as you can see, as yields go up, and I drew some quick blue lines just to kind of explain to you guys, as yields go up, the stock market will go down, and that's just a very natural concept where if the yield of a basically what's quote unquote risk-free asset is increasing, meaning you can get more for your money if you were to buy a treasury now than last week, and you don't have to worry about the gyrations of the market. It could be a really good move to be sitting in treasuries and people and entities and companies who are sitting on billions and billions of dollars in cash. That's what they're doing. They will be happy to sit on some short-term yields, not the 10-year, but maybe a couple months, maybe a year. And those yields are even higher But as the yields go up, stocks will go down. But we're getting to this kind of point where if yields don't turn around now and we start increasing yields to levels past the October and November area highs, you're going to see stocks plummet severely. And it's not just Tesla, but all the other stocks you own are gone. People are talking about it all the time, like, okay, TLT has to turn around, but the reality is TLT can be seeing new lows, which is the ETF that is for long bonds, 20 and 30 years. You can see those, the TLT at 91, like in no time flat. The yields can move very, very quickly based off one thing and one thing alone. Let's take a look at the USD over Japanese yen. And I highlighted some areas from last year. And these areas are, let's call back and just make mention of the tweets from Zero Hedge, which we were talking about, kind of snarkily talking about, when is the Bank of Japan going to start intervening when their yen is basically through the roof right now? What is it right now? Like 146 and 0.312 yen to the US dollar, which is very, very bad. And it's basically at similar levels where is Japan going to intervene again soon? It tried this in the past. It was, I wouldn't say super successful, but it did manage eventually to get the yen back down. And so what does that happen? So here is the here's the USD over Japanese yen. Okay, that's these green and red candles on the bottom part of this graph. And above it, or overlaid on it, is the comparison of the US 10-year yield. So if the yen is going up, you can see it around here. If the yen's going up and it's going up too much, and the Bank of Japan says enough, they'll just maybe buy a bunch of bonds and force the yen down. But what does that do? It makes our yields go up. You can see there's a direct correlation as the yen is basically manipulated to be lower in value. Yields would increase. And typically the reason for this is because maybe Japan, who is a very large holder of US treasuries, maybe just sells a bunch of treasuries, and which would then increase the yield of the treasuries, so they can get some cash to buy back their own Japanese bonds, which would send the yields down and then the yen down with those yields. And this is one example here where there's a very fairly large move, and around 4% within a day's time. Looking here, there was another intervention where over the course of a couple hours, the yen started getting a little bit out of control again. It was manipulated lower, and yields went up due to that. And same thing happened here, but unfortunately this time yields did fortunately go down as the value of the yen went down. So what we're probably going to see is maybe something similar if the yen still increases, gets weaker. Maybe a couple of manipulations will happen, and by the time those are over, hopefully the market would have bottomed by then, and the yields can dump, and then the yen can dump as well. But that took quite a long time. So from the start of the manipulations to when yields started finally coming back down to earth, that was a 49-day period. Let's hope it doesn't play out in the same exact way. But you're kind of understanding how the yields are the real culprit to the lack of upside to a lot of stocks, especially Tesla, who's always going to be really underperforming in situations like this. And we can see it even now. It's a little bit lower after hours. What I want you guys to really watch is the Asian market opens. I want you guys to watch the value of the yen. I want you to kind of keep tabs on perhaps hard stimulus coming from China. We know that they already are reducing rates, but there are large segments of their economy, specifically about the real estate companies are in dire straits, and that could really affect and infect the rest of their economy further. And so either it's going to be some type of stimulus that will get China's market moving back up, or it's going to be their lack of stimulus, which will send it even further down, because they've kind of been dragging their feet on this. This is something they should have been really considering. If they're going to do this now, they should have been done before, months ago, earlier in this year. But they were convinced, and maybe some parts of the world were pretty convinced, that China is on the up and up. And I think we've proven the fact that they are very on a precarious ledge of either just completely falling through when it comes to their economic growth for this year, or even into next year. Or this could be the moment where they go hard, really hard, and inject money, stimulus, or what have you, over the remaining parts of this month, and to try to find a footing. If they do that, markets in the U.S. would respond, I think, rather favorably. If they fail to do much more than what they have done, which is cut rates a little bit, like we're talking 15 basis points, it's just not really enough. And I think the market was red last night again in China, because it's obvious that wasn't going to do anything. And plus, there's a lot of roadblocks to investing in that country now. Biden really wants to limit the ability to invest in Chinese tech stocks. It's really limiting their ability to get materials and advanced chips, to limit their ability to, of course, create compute for their own AI program. So we'll see how it works out. But for now, this is, like I said in the beginning, it's really not too unexpected. After we get through the gap, guys, I really don't know if we really see support until we get kind of this neck of the woods. We'll just draw a box there for now. And this box will be kind of this consolidation of the spring highs. This could maybe be support. But I mean, let's just do a quick measurement from our after hours price into this kind of top of this range. And it's only 6.7%. We've been moving down like 3% over the last 2 days. So that could be something we can achieve by the end of the week, unfortunately. But I hate to sound bearish all the time. It's just that even from a technical perspective, it's very, very bearish. From an economic point of view, from a macro point of view, there's a lot of uncertainty with the ability of other parts of the world to maintain any growth, to save themselves from inflation. And what, the U.S. economy can be strong. It's selling off even more. It can be strong, sure, in comparison to those to rest of the world, really. But we can't exist with those markets in decline, with those markets keeping rates high, because at the end of the day, Tesla is an international company, and they have all these incentives in China and other parts of the world, be it through discounted peripherals, kickbacks on insurance or something like that in China. But it's all evidence that there could either be a demand issue, or Tesla knows that the affordability just isn't there for the product right now. There's Elon can say, no, there's unlimited demand. There can be unlimited demand just depending on the price of the product. Maybe the price of the product is too expensive for this environment. So we can give Elon and the Tesla team a lot of grief. But we don't know, how much money they're saving when it comes to the cost to produce these cars. Maybe they found some methods and renegotiated contracts to decrease those costs. But you really can't knock him too hard when he has to lower prices to move these cars. Because, yeah, I mean, we're moving cars, but just know that we're moving cars at the expense of other people selling cars. I mean, we're talking about, be it our rivals here in America and overseas. For every car we sell, that's one car that the other companies that we're competing against don't sell. And if you are cash rich like Tesla is, if you have a great ability to produce product in high volume, this might be the moment you just put your foot to the throat of everyone that's on the ground right now, and hope you come out as the top dog when it comes to not just EV manufacturing, but when it comes to just automobile manufacturing. So thanks so much, guys, for listening. Let's hope for a better day tomorrow. We keep saying that every day. It doesn't ever materialize. But cross your fingers. Let's hope. Thanks for listening. Bye.